This looks like the perfect opportunity to buy gold. The gold price has come down by 25%, and of course, we want to buy when prices are low. We want to potentially sell when prices are high. Unfortunately, life is not that easy. Yes, gold has come down and it did not correct by that much for a very long time. But the cycles in gold, they last for decades. Check out this long-term chart of gold. This is on a logarithmic scale. So in the 1970s, you could buy an ounce of gold for $35. Then we had a gold rush, but subsequently, price of gold fell by 70% over the course of 20 years. So are we really that cheap? Or is it more likely that a depression in gold will repeat again? And that maybe the price falls all the way down to $1,700. That's a question that we will answer in this video. Now, I don't have a crystal ball either, but there are interesting valuation approaches that are very uncommon that I believe are extremely useful. We can look not just at gold relative to silver, we can look at gold relative to the US money supply, for example, because gold is considered one of the hardest monies, and measuring the gold price in US dollars is actually not that useful. Now let's first see how hard gold really is. This is the annual supply growth of gold, a very long-term chart. On average, we are at 1.6%. So every year, 1.6% additional gold hits the market through mining. Now let's compare this with fiat currency. This is how quickly the US dollar expands in supply. This is USM2. Its growth rate on average is 6.8% per annum. So by the growth rate, we can tell how hard a money is. A money that expands by 1.6% is harder than a money that expands by 6.8%. And so that's why over the decades, measured in US dollars, gold tends to go up, simply because there's more and more US dollars and comparatively in relation, less gold. But there's just a very long-term tendency. That does not mean that the gold price can't drop by 70% and that a recovery, if you're buying at the wrong time, can take 30 years. This is now from 1979 to 2009. And of course, the US dollar was worth much more in 1979 compared to 2009. And so here's a chart you've probably never seen before. This is the gold price relative to the US money supply. How expensive is gold relative to all the fiat currency that's currently floating in the US? This chart is useful because it gives us an idea when gold might be expensive versus when it might be cheap. The dotted line, that's the average price of gold relative to the money supply. Given that reference price, gold could fall by another 32% from here. Now, what exactly are we implying with this chart? The idea is that very long term, all the US dollars that are floating around should be in a fixed ratio versus the market cap of gold. Yes, sometimes gold might be expensive, sometimes it might be cheap, but very long term, there should be an equilibrium. That's the idea. In other words, the gold price protects against monetary debasement completely. But is that actually true? It implies that the gold price would appreciate very long term by 6.8% per annum, the rate of the US money debasement. But that's not that realistic given that gold itself has an inflation. If there was a fixed gold supply and it never grew at all, then yes, it would appreciate by 6.8% long term. But because there is still gold mining, because the supply still grows over time, it probably will appreciate less than 6.8% per annum. Maybe rather by 5.2% per annum, right? The delta. Now let's compare those two price tops. This is now gold again relative to the US money supply. We've got the top in 1980. We've got the top this year, and we fell in the gold price between those two tops by 58%. Now, gold itself didn't fall. Gold relative to the US money supply fell. Now, that's over the course of 46 years. So let's take the 58%. We've got 47% left. Let's annualize this over 46 years and thus get how much on average does gold underperform the US monetary debasement per year, simply by taking those two data points. And the answer is 1.8% roughly. Isn't that surprisingly close to the supply growth rate of gold? of 1.6%. In other words, if we were not to compare the gold price relative to USM2, but instead the gold market cap relative to USM2, then those two tops would be aligning almost perfectly. The run up that we had up until the beginning of the 1980s, it's comparable with the run up we had recently. So we cannot make the argument that gold has another 230% potential from here. This equilibrium price story is too optimistic because gold cannot keep up with monetary debasement. It cannot long-term appreciate by 6.8% per annum because it itself grows by 1.6% every single year in supply. And so that's then the scary part. If those two tops align very well, and in the past we saw 20 years of gold depreciation, we had a bear market that destroyed more than 90% of purchasing power in gold. That makes this 25% drop that we've seen in the last few weeks not necessarily that attractive anymore. So since those two tops seem to be aligning almost perfectly when considering the debasement of gold itself as well, then let's just connect those two tops on a line and let's draw a few parallel lines to potentially get a trend channel. And of course that trend channel should go down long term because gold cannot 100% keep up with the debasement. So we could fall by 60% from here, we could fall by 82% or potentially 88% even. That's of course a very bearish scenario, and that's painting a picture that's not going to play out tomorrow and not this year and not next year, but maybe over the next 10, 20 years. It took a very long time with the prior bear market until momentum turned around. Now I'm simply just interpreting the data here. I don't have a crystal ball either. But to me this makes sense, right? We should value gold relative to the fiat currency because that's in the end what it's hedging. It's hedging a collapse of the fiat currency. It's not necessarily something that we still use for active trade. And so the more expensive gold is relative to the fiat base, the more cautious we should be. Now, what about silver though? What we've got over here, that's the gold price in green and the silver price in blue. And of course, the two assets tend to move in similar directions. As in, it almost behaves like Bitcoin versus Ethereum. When crypto goes up, then both go up. When crypto goes down, both go down. Or it's like technology stocks. When Google goes up, then Microsoft appreciates. When Meta goes down, Amazon crashes as well. In other words, within an asset class, we've got very high correlation. We don't have much correlation across asset classes, but we do have a lot of correlation within an asset class. Things within precious metals go up and down at the same time. Things within the tech sector and tech stocks go up and down at the same time. Things within crypto, same thing. The cycles are asset class dependent. If you want to diversify in a portfolio, if you want to de-risk, we should own different asset classes. We don't want to own many things within an asset class. And so of course, silver tends to move in similar directions to gold. That's why the charts look so similar. Still, let's have a look at the ratio. This is gold relative to silver. And again, the dotted line, that's the very long-term ratio. In other words, if we take the average since 1931, it took 58 silver ounces to buy 1 ounce of gold. This would imply that gold is actually slightly overvalued versus silver right now. And it could underperform by 17%. But here's the thing that I actually want to show in this chart. The movements to the equilibrium, they are not that large in magnitude. It's 78% from the bottom to the top. Here it's a drawdown of roughly 50%. That's nowhere near comparable to the cycles that we have in the gold price relative to the money supply, right? This drop of 90% over here, or this appreciation of 300% over here. So the decision whether or not to heavily engage in precious metals is much more important than the decision between gold and silver. And this is a general learning, right? The decision if we should be heavily engaged in crypto is much more important than the decision what altcoin to pick, or if you should buy Bitcoin or Ethereum. What's more important is to time the general macro. There are times when asset class A is very hyped and asset class B is overlooked, and vice versa. Right now, everybody talks about technology stocks. A few months ago, everybody talked about gold. Now, bit by bit, capital is flowing out of gold again. Gold is not that hip anymore. And of course, we've already seen the outflows from crypto a long time ago, right? Bitcoin already fell by 50% from the all-time high. But this is not a Bitcoin video. This is a video on gold and silver. And again, I don't think it's that important that gold is a bit more expensive relative to silver right now. I think it's much more important that gold in the grand scheme of things is very expensive relative to the US money supply. And it's not just that. The issue is that the cycles in gold, they just last decades. So if we don't exit at the right time, we can wait for another 20, 30 years. And we've basically just saved in gold for our children and grandchildren. We have not made money for ourselves. This is very different to the crypto market, right? The crypto market tended to recover in 4-year cycles. Here in gold, the cycles are 20, 30 years in length. And so paradoxically enough, we could, by that measure, call Bitcoin even less risky than gold. Of course, Bitcoin has more volatility. It goes up and down more day after day. But if we just buy and hold, and we don't buy at the perfect time, then we might get bailed out with Bitcoin faster than we do with other asset classes. Now, of course, there's a reason why the gold price has rallied in the last years. And that's at least partially because of the questionable situation with the financial situation in the US. What we've got over here, that's the US debt to GDP. This is a chart that everybody looks at, but it's not the full story. Again, yes, US debt to GDP is very high, but the US has been able to turn things around in the past at a very similar level. Now, here's what most people don't look at. This is the US household debt to GDP. So that's a private debt. So we've got public debt over here. We've got private debt over here. If we add this, then the chart does not look pretty at all. We are at 190% debt to GDP. So in other words, 2 years of income are debt. Think about your own annual income. And now imagine you had 2 times that annual income in debt. That's currently the situation for the average American if we add private and public debt together. Now, there's actually a system behind this. The reason why the debt to GDP is so high, because the US dollar devalues over time. If the US is able to pay less than 6.8% per annum on their debt, they're actually doing fine, right? This is the same mechanic how many people get rich with property. If you borrow in order to buy a house and you only pay, say, 3 or 4% per annum on that debt, and then at the same time, the money devalues by 6, 7% per annum, you are making that spread, right? Your debt devalues, but your house is expected to appreciate at a faster rate because of the debt devaluation, and then long term you make money. That's why most homeowners became wealthy long term. The debasement of the fiat currency is faster compared to what needs to be paid in interest rate. The higher this is levered up, the better. And so the governments are doing something very similar. They're debasing their currency at a faster rate than what they have to pay in interest rate. And so it's actually smart to have a lot of debt. But of course, it's only smart if the payments can be made easily. There is a point when things turn around, because if interest rate payments relative to tax income become higher and higher, then people will actually notice how the game works. Then people will see that all of the coupon payments from the bonds are just newly issued money. Then the monetary base will grow much, much quicker. And that's really fundamentally the bet that's currently made with gold. It's a bet that the US dollar will devalue much faster in the future than it did in the past. And again, that's because of the problematic financial situation of the US. Now, there are also other voices. For example, China, right? China does not hold US treasuries that much anymore. Their peak holdings were in November 2013. But really, China isn't a problem anymore. Have a look at China's US treasury holdings as a percent of US money supply. Again, 2010 was the peak. 13% of the supply was owned by China. Now it's down to 3%. So China has already offloaded the vast majority of their treasuries. Not measured in US dollars, but measured versus the money supply. And that's in the end what counts. And this decline in US-China treasury holdings was not a big problem for the US dollar strength. First, we can say that going forward, there won't be much more selling anymore, right? This is already very low at 3%. We've come down 10 percentage points. The last 3 percentage points won't do much. But secondly, that peak in 2010, That was over here. This is now DXY, so the dollar strength index. How strong is the US dollar versus other fiat currencies? That actually went up since China started to sell treasuries. The US dollar has appreciated by roughly 25% versus other fiat currencies. Now, I'm not saying that the US dollar is a great investment, but at least it didn't lose more than other fiat. This move from China was no problem at all. This is an overhyped narrative when we actually look at the data. So this is what I take from all of this. Gold is definitely not cheap. Even after the 25% decline, gold can decline much, much further. That does not mean we should not own any gold or any silver at all. It can be a good insurance against the worst case because, again, the financial situation of the US looks very bad. I personally do own some gold. I've got roughly 2% of my net worth in physical gold. I don't have this in ETFs because, again, if the complete system collapses, we want to have this in physical gold, not in some random ETF that we can't withdraw. So as an insurance against the worst case, owning some physical gold does make sense. But don't expect to make money with that physical gold. Rather expect and hope for that physical gold will go down in purchasing power over the next 10-20 years, because then the other 98% of your portfolio will probably have performed very well. If gold appreciates, if those 2% that you hold, if they suddenly shoot through the roof, then the rest of your entire portfolio is crashing. Now, having more allocation towards gold, again, I don't think is a good idea because it is just like an insurance. We don't want to buy tons of insurance hoping for the worst case. And I think I've made my case clear that gold, very long term, does not look cheap and that it's very risky to buy into negative momentum because a bear market for gold can take a very, very long time. Gold was a trendy asset over the last 3 years, but I think that the trend is now turning around. Again, I don't think we should not own any of it. I think it makes sense to have some as an insurance, but it's important to have the right weight per asset class in a portfolio. We want to own all of the asset classes. We want to have stocks, precious metals, property, potentially some crypto, Bitcoin, etc. as well. But we want to have the right allocation at the right time. We don't want to hold only crypto when crypto just made new all-time highs, and we don't want to hold a lot of gold when currently the momentum turns around. I'm stating this as if I knew what the future will hold, but I'm simply just presenting the data here, right? I just want to make a point how I personally see this. By the way, I have made a cheat sheet around this entire topic. How money flows across asset classes, how to do relative valuations of one asset class versus the other, how interest rates impact everything. That cheat sheet is completely for free. You can either get it by entering your email over here, or you can click here, get this on Telegram, alternatively scan this, then you can also get it via Telegram. There's no payment needed, there's no credit card needed, it's 100% free. If it's your first time here, feel free to subscribe. I publish videos regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time. Cheers!